How do you see the relationship between Bitcoin and risk assets playing out over the next few months?
I think that no politician has the mandate or the balls to tank the economy and just say, all right, fuck you, America / the world. I think Bitcoin will, I'm hyper bullish Bitcoin over the next few months. I think that Bitcoin's performance will beget more performance if it continues.
Do you think we're now going into potentially like a super cycle, or do you think that it will play out with the normal 4-year cycle and we are likely to top out sometime this year?
I think we're going into super cycle. I don't believe in the 4-year cycle. I think that's over.
What are you actively shorting and what are you very bullish on and holding?
So basically what I coined on the 1000X podcast was inverse alt season is the new alt season. You can just be short alts and make money 4 out of every 5 days. Like my favorite short is WIF. What a disgusting dog shit token, right?
You've seen markets at their best and their worst. Crypto can be quite brutal. So like 80% drawdowns, exchange blowups in 2022, etc. You name it. Yet you're still here. What keeps you in the game? GM, and welcome back to another interview here on Coin Bureau. Now today we are being joined by Jonah van Bourg. He is a veteran Wall Street trader and a commodity trader who is now a full-time crypto trader. So one of us. And he's also the co-host of the 1000X podcast, one of my personal go-to favorites. So Jonah, welcome to the Coin Bureau.
Thank you for having me, and thank you for listening to the 1000X podcast.
Big fan.
I can't believe anybody listens to that, but appreciate
it. There are many, trust me. You and Navi really got it going. So 2 quick things before we kick off, guys. Firstly, as we mentioned, if you're not already listening to the 1000X podcast, you are missing out. Jonah and Avi have had some really good calls lately, and they have a really engaging conversation, especially from a trader's perspective. So I recommend checking it out. The link will be down below. And then, of course, secondly, nothing in this video is financial or investment advice. Please consult the disclaimer in the description, as well as your own investment advisor. Cool. So, Jonah, you've got a really extensive and interesting TradFi and commodities background, as I said. And it would be great to give our audience just a bit of an overview of your journey all the way from your first job at Lehman, I believe, to running oil desks and now trading crypto.
Yeah, sure. Thank you. Okay, so I graduated from college in 2007 and took what I thought was a relatively prestigious, good job at the time, which was trading basically corporate bonds and credit default swaps at Lehman Brothers in 2007. Lehman was on the up and up. Everything looked great. I was, patting myself on the back, feeling pretty good about things. And then a year later, Lehman went bankrupt. Everybody got fired. And then Barclays kind of bought Lehman out of bankruptcy. And the way that they did that was they sent all of us employees an email saying, "Dear Lehman employee, would you like to accept or reject a temporary 90-day offer of provisional employment from Barclays Capital? Please reply with accept in the subject line if you want to have a job, or reject if you don't." So obviously I was 22. I wrote accept, and then just sort of sat around at Barclays surviving weekly rounds of firings. They laid off like 15,000 people, which is a real job. I was meeting with, the Bobs from Office Space every week, trying to explain why I deserved a job. And the explanation was, hey, I'm the cheapest person here and the most technical. And when you fire somebody, I can figure out their Excel spreadsheet faster. So that sort of kept me employed until I finally managed to get a real job, which was on the oil trading desk at Goldman Sachs. And that's where I started building my career. So I started off as the junior guy and ended up running the global oil derivatives trading business. And then I got poached by Vitol in 2015. Vitol is the largest oil trading company in the world. Became a partner there. Was there for 7 years, sort of trading physical and financial crude oil on the crude oil team. And then 2021, when crypto was booming, I got approached by DRW to run their, global crypto and precious metals trading business, which for me was a huge step up in responsibility and, management, learn new things, high frequency trading, all that good stuff. And I'd been personally trading crypto for a long time, and I'd turned it into a pretty decent source of income for myself as a side hustle, just trading crypto. So I felt the confidence to do it institutionally. I was there for 2 years until the SEC smackdown happened, at which point I decided to go independent to avoid having any relationship to the Operation Choke Point 2.0 lawsuits, all of that stuff. It's very, very risky personally to be involved in anything that could get your name on a government, legal action. So now I just trade crypto independently. And what Avi and I are trying to do with our podcast is create kind of that trading floor dialogue. I heard you say before the call that you worked at Goldman as well. A lot of information gets passed around on trading floors. There's a lot of dialogue. And, for independent crypto traders out there, maybe you're just sitting in your attic or your basement or your office, missing some of that banter and that flow of dialogue that helps you stress test your ideas. So Avi and I, Avi was a client of mine when I was at DRW, or a counterparty, I should say. We would trade with each other all the time and talk to each other once a week about markets. Because as every good trader is going to be calling other traders, talking to them about markets all the time, just to make sure they're not in groupthink or some sort of destructive personal idea bubble, missing something obvious. And Avi was my favorite markets call. And we just said, hey, why don't we just turn this into a podcast and see if it sticks? And it did. So we're sort of trying to recreate that trading floor atmosphere that you would get working at one of the big white shoe firms. And as a crypto trader, I actually think it's better not to work at one of those firms. So we're sort of trying to democratize and decentralize the conversations that accompany good trading.
Now, that's really, really interesting because it ties into my second question. I guess, why do you say crypto traders should not work at those firms at all? Are you talking more generally around TradFi trading, like normal traditional markets, or crypto trading firms and institutional crypto trading firms? Because I'm curious, and this ties into the question that I had, is like your background trading, for example, commodities and derivatives on commodities. How has that informed and helped your trading in crypto?
So it turns out that crypto trades a lot like commodities trade. So my, 18 years of experience trading commodities has come in handy when it comes to trading crypto. There's definitely a lot of parallels. One of which is just learning how to ride a volatile trade, learning how to stay in a trade when things don't go your way, understanding the dynamics of supply and demand, understanding when when it's trading like an episodic macro asset versus when it's trading like a fundamentally driven micro asset. Commodities flip back and forth. They're kind of schizophrenic. So are crypto assets. So all, just basically like the basics, the infrastructure is the same for trading both markets, but like the intellectual infrastructure is the same for trading both markets. The market structure is very different. So if you just want to be a personal, independent guy in in Mexico trading jet fuel, good luck, right? It's impossible. You don't have, you're not like you're not clearing with the right exchanges as an individual. At best, you're just trading some second order derivative product linked to the actual, exchange listed derivatives. There's no OTC access. You have no pricing power. Like, in order to really professionally trade commodities, you have to work at a big firm that has all the legal and kind of back office set up for you. And also, those dialogues are very sequestered and siloed, and you need to be inside of the right firms with the right infrastructure and research in order to benefit. The opposite is true for crypto. If you work inside a big institutional firm, you're exposed to, the legal risks that I experienced at DRW. You're exposed to the, great firm, not their fault, but the SEC, it's public. They went after them for what I would argue are just absolute nonsense reasons. So you're exposed to the legal downside, the regulatory whims in Washington, or whatever jurisdiction you're trading in. Also, traditional firms tend to have super tight guardrails around institutional risk management. They don't, institutional firms like TradFi firms like to preserve capital. They don't like to risk that much, which is fine if you're trading interest rates, but it's very hard to profit from, institutionally sized crypto asset portfolio if you're not allowed to draw down more than 10 or 15%. That, there are fat tails in crypto, and you have to be able to profit from them. The options markets are underdeveloped, so it's, it's relatively inefficient. And I think that as a PA trader, you have a massive advantage over institutions that'll have restrictions on what assets you can trade, what DeFi protocols you can farm on, what you can do, what you can't do. You have to talk to lots of lawyers, and even if you'd picked the absolute best possible trade, which would have been to buy Bitcoin or GBTC on the lows in December 2022 and just ride that all the way to Valhalla, in hindsight, best trade ever. If you'd put that on at an institution with a, let's say a 10% drawdown limit, you would have been stopped out 6 times on the way up, right? You wouldn't have been able to actually capture the move. So, I guess to conclude this rant, as a retail trader sitting anywhere in the world without any firm behind you, you have an advantage over all of the institutions. You have an advantage in what you can trade. and because they have their risk limits, they can't trade certain things, they can't do certain things on certain protocols. You can. So you're just like it's kind of the opposite of commodities. You're much better set up as a retail trader than as an institutional trader.
Yeah, really democratizes trading and finance for everyone, right?
Yeah.
So just coming back to your trading strategy more specifically, I'm keen to know a bit more about it and how you technically approach your trading. So what's your specific framework or strategy, time horizon, style of trading, et cetera, et cetera?
I've been told this by colleagues. You have to know your strengths and your weaknesses as a trader. I tend to have a very good long-term beat on the market. I usually get that right. In the very, very short term, I have a good ability to smell blood in the water and get out of a position that's going to destroy me or get into something that's about to go crazy. I have that pulse, but the medium term is kind of a weak spot for me. Medium term being like anything between a time horizon of a day and a month. I've just never been good at that. So what I like to do is I manually trade long-term things and I manually risk manage my positions if something's going haywire. So that covers my long-term and my short-term. And then in that sort of intermediate term, I try not to click trade that much, and I deploy systematic models to systematic strategies that I can kind of lean on as a crutch and cling to when things are going well or poorly. It's hard to sell a position that's a winner. It's hard to double down and buy something that's going, nuking in your face. So I prefer to have a crutch. I prefer to have kind of like a process-driven set of analytics to tell me when to buy and sell things with call it a 1 day to maybe a multiple month horizon. And then I have, long-term cycle bags like Bitcoin, recently added Hyperliquid, Solana, looking at TAO. But I think that in terms of, short-term trading, I leave that to a bot.
Yeah. And then when it comes to like toolboxes, tools in your toolbox or frameworks, do you use technicals? Do you say algorithmic? Do you look at like, I know you focus sometimes on pairs trading. Do you have any sort of like go-to tools in your toolbox?
Yeah. I mean, I don't really believe in technical trading. I think that, there's a lot of stuff that a lot of rabbit holes on YouTube you can go into about Ichimoku clouds and RSI and all this crap. I'm not really into it. I think it's all voodoo. I do think that trends are real, and I do think that ranges are real. So I think that, if you want to use a moving average or an exponentially weighted moving average or Bollinger Bands as like a very loose heuristic to be taken with a massive grain of salt, that's okay. But if people are trying to tell you that they have a technical model that will make you money, I think you're supposed to just call them out as charlatans or walk away. And the reason why, no offense to anybody that does that, is one thing I've learned from my long career in TradFi, which is, I have the self-confidence now to say that it wasn't an accident. Like I survived for 18 years, not because I was lucky, but because I was both lucky and good. I think what I've learned is that if somebody's trying to sell you a model or shill you a model, it's inherently an invalid model, because if it were valid, they would keep it a secret and trade it themselves and make way more money. That's kind of, if they actually believed in it, they would not share it. They would not democratize it, because democratizing a trading model means that all the alpha decays. So it's just logically inconsistent to buy somebody else's model and try to use it to make money. It makes no sense whatsoever.
Jonah, many meme coin technical analysts on crypto Twitter will take issue with the fact you've called their craft voodoo.
Yeah. Well, that's why there's a marketplace of opinions, right? Come listen to the 1000X podcast if you want to have my style of analysis, or if you prefer to just to hit the easy button and buy somebody's relative strength index based trading model for meme coins. You got content out there for sure.
Yeah, for sure. So just coming back to some advice, obviously you're an expert trader with many years of experience. So if you were to just distill, what's some advice you have for those retail guys who are just now trying their luck? They may not necessarily have an edge. They may be just beginning. Obviously on one thing is listen to you guys in the 1000X, but can, anyone be in the market? How do they get your mind? Like what sort of mindset tips do you have, or like just beginner tips do you have for them?
Well, there are all sorts of trading truisms out there that I read earlier in my career. Things like mind like water. I used to think, what does that even mean? Now I kind of have a feel for it. But like, I think the real advice to, what I would advise myself when I was getting into liquid trading for the first time would be, don't overtrade, because chopping in and out of positions is how you bleed. Transaction costs are guaranteed, right? They're small, but they're guaranteed. So every time you chop in and out of a position, you lose a bit of money. So don't overtrade. Try to hold on to things for the long term. Learn to ride a trade even when it's going against you. And finally, and this is the most important one, have an objective framework that you can cling to when you're losing money. And that's so important, right? If the only framework that you have for holding or not holding a position is how much money you're making or losing on it, you're going to be tempted to buy high and sell low. So as the advice goes, buy low, sell high. Obviously it sounds good in theory, but in practice it's very hard. I think the piece of advice that I would give to younger traders, or a younger version of me, would be the way that you buy low and sell high is by having an objective framework. And what I mean by it, because and P&L is not an objective framework, because if you're losing money and that's your only framework, then you get scared and you sell, so to prevent greater losses. Or if you're making money, you get confident and you buy more to try and get greedy. That again is the opposite of what you should be doing. So I would say, here's an example of an objective framework. An objective framework can be as simple as, I believe that Bitcoin will surpass the market cap of gold. The market cap of Bitcoin will surpass the market cap of gold sometime over my lifetime. Extremely long-term view. Immediately you have an edge over any individual or institution with a shorter term view, because maybe they have to report quarterly earnings, or maybe they bonus their traders once a year. If you have a long time frame, that gives you staying power that other participants don't have, which inherently is an advantage. So let's say that I think that Bitcoin is going to surpass the market cap of gold, and Bitcoin is down 50%. I'm losing money. I'm hurting. I'm bleeding. I look at my position, and instead of saying, oh, I'm losing money, I should get out, I say, has Bitcoin surpassed the market cap of gold yet? No. Okay, I'm going to go on vacation and hold on, right? And if you've done that, obviously you have to be right. Your framework has to be right. You have to be right in your views. That's a framework that I have. I genuinely believe that. I think that Bitcoin with time will surpass gold as the world's alternative reserve currency of choice, the sort of non-sovereign money. And that's a very powerful framework to cling to when I'm losing money. I feel confidence. Now, obviously, the other thing is, don't bet more than you can afford to lose. The two go hand in hand, right? Because it doesn't matter if your long-term view is right if you're forced to stop out on the lows because you need to, pay your mortgage or something. So definitely don't bet more than you can afford to lose. Don't use leverage. Don't overtrade. And have a framework. A framework can also be, it doesn't have to be a super long-term qualitative framework. A framework could be a shorter thing like, hey, I've noticed that token X leads token Y, meaning token X moves first and token Y moves second. So let me just run some moving averages on token X. When the price of token X is above those moving averages, I'm long token Y. And when it's below, I'm short token Y, because, the laggard follows the leader, right? That could be another framework. And when you're temporarily losing money on that, if you've back tested your framework well enough, you can say, I don't care. I don't care that I'm down. I'll make it all back, and then some, just by sticking to this plan, adhering to this framework. And I think that's the best advice I could possibly give to somebody who's starting out. Or the opposite of that advice would be, don't just buy and sell things based on narratives that you see on Twitter with no objective framework behind it. Try to develop your own thinking and your own analysis and your own convictions, and rigorously adhere to them even when it hurts.
Yeah, that's great advice. But then I'm just curious in terms of is there anything that at what stage people need to reassess their frameworks, or it could potentially be invalidated? I mean, I'm sure there's been many times in your past where you've thought it through a framework and then it's just been proven incorrect by, invalidated by something else. I believe, for example, ETH, until last year or sometime you were holding ETH. So I'm curious in terms of although it's good to stick to a framework and view it religiously and have a time frame and all that, should one also not think about ways in which their frameworks could be invalidated, because you don't want to be holding something going to zero, or you don't want to get stopped out, right?
Yeah, I mean, that's a great point you bring up. I'm glad you did. In systematic trading, the way that you would determine that your framework is invalid is if the Sharpe ratio of your observed results is inconsistent with the Sharpe ratio of your back-tested results in a way that's too divergent to be like random noise, right?
Risk return.
Yeah. So basically,
Yeah.
let's say you backtest a strategy with a Sharpe ratio of 10, and then you deploy it and your Sharpe ratio is -1. That's an extreme example, but you should know pretty quick the math behind that is like, hey, this should happen once every 100 years. This sort of underperformance, something's really wrong here. So then you could turn it off. Equally, so basically, the higher your backtested Sharpe, the quicker you should know if your observed results are consistent with what you expect. And that's for systematic trading. And I guess we could draw a corollary to more discretionary long-term trading. If I believe that ETH is the world computer and it's this extremely relevant decentralized crypto asset, and a year goes by where the Sharpe ratio of ETH BTC is like -5, it's like the most smooth downtrend of all time, just losing money 4 out of every 5 days for ETH holders. That's a way of the market telling you like, hey, your thesis is wrong. It's not like things were going great and then an asteroid hit Vitalik Buterin in the face and the market went down a lot. Then maybe your thesis is you just got unlucky, or maybe your thesis is valid and the market will recover after they appoint a new head of the foundation. It's more just like there's something going on that I've either misunderstood or neglected to take into account. And the consistency of the negative returns is so strong that what I like so divergent from my expectations with such consistency that I need to reevaluate.
Got it. And now just come back to some of the other strategies you guys employ. And I hear you guys talking about it a lot, and that's pairs trading, right?
Yeah.
And technically, obviously, and how you run your pairs trade, because obviously, most what you could do is you obviously go long and short the same notional, the two different assets, right? Because unless the pair itself is listed on the most exchanges, which it isn't on those occasions. So I'm curious, like just a technical question, like how do you manage the risk for those? Because as far as I understand, most exchanges don't have the functionality for sort of conditional like stop orders and that kind of stuff. So how do you guys limit the losses potentially if there is a massive divergence in the two assets and the pairs goes completely haywire?
I like to trade pairs that are listed for the most part. I did
Okay.
Cardano versus Litecoin for a little while. I don't think it's
Okay.
that hard to risk manage. You just have to if you're trading a listed pair, you can set your stops manually. If you're trading an unlisted pair like Cardano versus LTC, you kind of have to monitor the two individually and just be more on top of it. It's not that hard. I also don't trade massive size in pairs. My favorite pairs trading is just like shorting ETH versus longing something else. Or
Short and ETH.
yeah,
Just short ETH, bro. Naked short that shit.
it's a great short.
Yeah, man.
Maybe less great these days now that it's run so much. Bitcoin's run
Yeah,
so much relative to ETH, but I mean, honestly, like pairs trading is a good way to abstract out the impact of macro on your
yeah,
crypto positions. But I don't really treat it any differently than just trading outright crypto. Why? Because crypto is always a pairs trade. If you buy Bitcoin outright, it's BTC USD. It's a pair trade versus the dollar, and the dollar moves too. So I don't really treat it. I don't give it special status. I just think like, do I want macro volatility in this? Yes or no? Like if my thesis is literally that Hyperliquid will outperform other crypto assets, I'll buy Hyperliquid versus ETH. And if my thesis, like especially if I'm worried about broader crypto, right, or worried about macro taking crypto down, then I'll buy something versus shorting ETH. But like if I'm, for example, on these Trump tariffs, I think the market was overly panicked, and I wanted to add to my bags, and I thought not only would I like to buy these certain crypto assets, but also I don't want to short ETH because I think that everything is going to bounce, including ETH. I'll just buy it outright. I do most of my crypto trading outright, and I trade from the long side because I'm obviously I've been crypto pilled. I deeply believe in what we're doing here, and I have a lot of reasons and theses behind that. So
yeah, got it. So now you've mentioned the Trump tariffs. So let's just move on now to what's going on in the markets, right? Because today is the day that Trump announced that, or it was yesterday, but Trump announced that not only are the tariffs in China being reduced, but also he's not looking to fire Jerome anymore. And it seems a lot of the fears are now being walked back. Markets are rallying like crazy, TradFi as well. So it's that proverbial, it's over, we're back, it's over, we're back kind of meme.
yeah,
So how are you reading it right now, just straight off the bat?
I have a pretty simple thesis. I started at Lehman Brothers, And it's been a pretty much one-way train upwards since then, with a few dips that were great buys, the last basically 20 years, 18 years ish. So if I had been a perma bear or even a range trader, I wouldn't have made it this far. So there's some survivorship bias when you talk to people these days. You tend to talk to bulls. So I'm a bull, but I do have a kind of a trigger point for when I think that the great bull trend is going to end. And let me just describe my overarching market thesis. I think that no politician has the mandate or the balls to tank the economy, right? So it's really as simple as that. I think that this has been my bet all along. Every time markets dip, even if it's something exogenous and unpredictable like COVID, or something that's kind of like manufactured, like Trump coming in and reordering global trade with some speeches and tweets, nobody who's in charge of markets has the mandate or the balls to let them tank. And the reason why is that the genie was let out of the bottle in 2008 when they started pumping stimulus into the economy to basically buoy assets and transfer risk from corporate balance sheets onto the balance sheets of the Treasury and the central bank, right? That genie was out of the bottle. If you want to put that genie back in the bottle, you have to take not just the medicine that the economy didn't take in 2008, but the medicine that it didn't take in 2020 and the medicine that it didn't take in 2025. And you're going to send the stock market down 90% right back to the lows of 2008 if you take those three pills and just say, all right, fuck you, America / the world, go bankrupt if you're mismanaged. And many people, if not most, will, even the too big to fail institutions, because they no longer have backing. So I don't think any politician actually can let that happen, because no politician's been elected with that strong of a mandate, and no politician, especially not Trump, right? He wants his head on Mount Rushmore, is more going to be in the same category as like Herbert Hoover or whoever presided over like horrendous periods in American economic history if he lets that happen. So basically my thesis has been just call the bluff every time, buy the dip, tax loss harvest what you bought at higher levels, and buy the dip, and it'll work out. And it has. And the only time that I will reverse my stance on this is when somebody actually gets elected with the mandate to, basically revert to socialism and send corporate America into a tailspin. So basically what I'm looking out for is like an AOC or a Bernie Sanders, like a wave of that style of politician. Like if they start taking over big Western capitalist countries with the kind of like power of the people message, then I do think I do think that there will have been a mandate at that point. Hopefully it never comes, but if it does, there will have been a mandate to say like corporate America has usurped the working man for too long, and who cares what their stock price is. At that point, I'll sell everything. Until then, I'm going to buy every dip.
Yeah. There's a strong Trump put in the market, you say.
Yeah, and people said, oh, no, this time is different. Look, Trump manufactured this crisis. He's not going to bail himself out with stimulus. And I'm consistently betting on the opposite. I'm saying he is going to flinch. He is going to reverse course. And already I think I'm being proven right. So I think these are decent levels to buy still.
Yeah, he was quite conciliatory in his comments yesterday as related to not only China, but, Powell. It seems like someone gave him a readout and he's basically like, just got to calm the markets right now. I'm sure Besant and co basically pulled him aside and been like, yo, Trump,
hey,
you need to calm this down right now, man. Yeah. The Besant put, let's put it the Besant put. We can drag him along.
One thing I do think Trump has accomplished with this, though, is like I'm one of the few people I think in the world who's willing to give Trump the benefit of the doubt. I think that important things take longer than a couple of weeks to play out sometimes. I just kind of like, having done a few negotiations myself now, including some high stakes ones, I see the value in throwing your negotiation counterparties into a state of confusion, and I think chaos is an overused word, but let's just say a state where they're not sure necessarily what's in Trump's head. I think that not telegraphing, not showing your hands at the poker table can be a valuable negotiating tactic at times. So, there's no shortage of negative opinions about these tariffs out there. I'm willing to give him the benefit of the doubt and think optimistically and say, well, we may end up in a better situation from the perspective of global trade if this guy doesn't just show his hand and allow all of the game theoretic opponents in this zero sum game to effectively read his cards and play him based on his cards. Like seems kind of normal almost. But in politics, maybe you're expected to be more transparent. I don't know.
So you think there's a method to the madness?
I don't think he had a plan coming into this other than that he wanted to bring more manufacturing. Loose. I think there were like loose objectives, but no plan. I think what he's done is he's basically, which does make sense for better or for worse, is he recognizes that as the world's biggest customer, the United States is the world's biggest customer, importer, and runs the world's biggest trade deficits. He does have the power in a negotiation. So if he initiates a negotiation and throws everybody else onto their back foot, even if there's no plan, I think his gut feel is correct that he can drive whatever outcome occurs as a result of his chaotic actions to the benefit of the United States by leveraging his position, his consistent position of strength, and kind of playing it by ear along the way. That's not crazy, but yes, there's. I don't think there's a concrete plan, a master plan behind this, other than what I just mentioned. What do you think?
I think that I don't think they thought this through at all. I think it's kind of like that left foot hasn't been talking to the right foot in terms of the administration. And there was this rough idea to implement some sort of this Mar-a-Lago Accord, where you try and force countries to come to the table by tariffing them first. But you don't, if you're trying to negotiate bespoke trade deals and get people to the table, you don't tariff all of your allies right out the gates and then say, come speak to us before, you should have done that before you go and try and, if you want to isolate your geopolitical rival in terms of China. So it just wasn't well executed at all. There was a way better way to execute this, way more coordinated, way smarter. And because of, and we may only still see the effects of this in terms of the uncertainty on business play out later on. But that's my personal view.
No, I appreciate your view. I think you have a much more kind of mainstream consensus view than I do. I know I'm the outlier here in thinking that this could work out quite well for both markets and for Trump. But I think what this chaos creates, markets hate volatility, and they're lower on basically the execution of this tariff stuff, as you mentioned, for obvious reasons. That I think that presents an opportunity, and here's why. Let's say that you're right, and that this is just a complete shit show, and it's ultimately going to result in problems for global trade that take economies into like semi-recession, right? Semi-recession mode. For reasons that I mentioned earlier, I don't think that global politicians and policymakers and central bankers can stomach that. So I do think they will turn on the printing press again if things get much worse. And there's one thing we know that hedges you against currency debasement better than anything else: Bitcoin, right? Bitcoin's taken a hit because, along with other risk assets. And so if things really continue to get worse, and you're right, I think Bitcoin will rip when the printing presses go on. Not just like a 2-bagger, maybe like a 5-bagger, right? Something that you can feel very happy about if you bought Bitcoin against the rest of your portfolio, or even outright. Let's say that I'm right, and this ends up working out. Trump ends up backing off, and there's a new trade agreement that doesn't look that dissimilar from the previous trade agreement. I think markets rip, including Bitcoin. And maybe you don't get a currency debasement scenario for Bitcoin, but I think it certainly trades with beta to the stock market and blasts through all-time highs, no problem. If we end up if Trump in a year's time is parading around saying, look, I told you so. Now we have a new WTO that doesn't include China, and everybody's better off, and markets are buying it, right? Which I think they would. In either case, I feel like Bitcoin is an important part of portfolio construction and is a really elegant trade for this particular environment, especially now that it's decoupling from equities to the upside.
Totally agree. And that now, of course, brings us to my next question, and that's specifically the decoupling, right? So ever since Liberation Day, Bitcoin is up, whereas still some of the stocks are down. And over the past 3 days, especially on Monday, when the dollar was collapsing and stocks were falling through the floor, Bitcoin and gold were rallying. So now, is this the famed decoupling, or do you think we kind of like getting ahead of ourselves? Obviously, it's now rallying as well with risk assets. So it's kind of like, well, it was decoupling to the upside when stocks were crashing, but now it's rallying with stocks as well. So how do you see the relationship between Bitcoin and risk assets playing out over the next few months?
I think Bitcoin will, I'm hyper bullish Bitcoin over the next few months. I look at the IBIT SPY ratio. You could look at Bitcoin SPX, but IBIT and SPY are both ETFs that have the same close. So it helps me. BTC Bitcoin on Coinbase versus the S&P 500 index ticker will give you a longer history, but IBIT SPY will tell you how it's performing day to day with good resolution, just because they those instruments share the same close. And IBIT SPY is basically at all-time highs. So I think what it tells you is that Bitcoin is trading like a debasement hedge to the downside and a risk asset to the upside, which is extremely, extremely heartening for Bitcoin holders. Why? Because, capital allocators really have no alternative for risk assets other than the S&P 500, and maybe they're allowed to own a little bit of gold, but not much. And I think Bitcoin has not really been on institutional radars until now. If it continues decoupling to the upside from stocks, it legitimizes itself as a real hedge for, a multipolar trade scenario or currency debasement. And then I think the institutional capital space will go from, say, looking at portfolio construction from the perspective of, 100% stocks, bonds, and maybe some commodities to like 99% stocks, bonds, and commodities and 1% Bitcoin. And that's like $1 million per token in BTC. So I really think that I think that Bitcoin's performance will beget more performance if it continues, and we're at a fragile inflection point where possibly if this continues, it could go pretty hard. Obviously, there's the scenario where it just reverts back down to equities, and IBIT SPY is trading wherever it was post-election, maybe down 10% or 15% from here. But I think that the risk reward to the upside is massive, and I'm still looking at being long Bitcoin.
Got it. Do you view it more, or do you think that this thinking about the cycle, the concept of the Bitcoin cycle, the market cycle, the way I hear you saying it, do you think we're now going into potentially like a super cycle, or do you think that it will play out with the normal 4-year cycle and we are likely to top out sometime this year?
I think we're going into super cycle. I don't believe in the 4-year cycle. I think that's over.
Okay. That's over. Got it. So
Yep.
Super cycle. There we go.
Super cycles are driven by demand, right? Like in commodities, the big super cycle in oil was in the 2000s when China was going from, tin pot republic with billions of people to, like real first world country, making a lot of people wealthy. And they needed a lot of commodities. So that drove the commodity super cycle of the 2000s. Super cycles are always driven by demand, right? And not supply. Like supply shocks send markets higher, but temporarily. Demand growth, like massive surfable waves of demand growth are what drives super cycles. And I do think that we are starting to see the beginnings. I don't know how many surfers listen to your podcast, but I think, if you read the water, there's a massive surfable wave break forming in Bitcoin, kind of on the horizon. And the reason why I think so is I see multiple demand bases that control tens of trillions of dollars looking at Bitcoin for a variety of reasons. Everything from, hey, this is a debasement hedge. Hey, it's portfolio diversification. Hey, it's digital gold, to like, oh my God, the dollar could potentially be compromised as a store of value and a means of exchange for high ticket global trade. Not like buying a coffee, but like buying $100 million cargo of jet fuel, right? Like for big ticket global trade, the dollar could potentially be losing its edge as the denominator for these big transactions as we enter, as we deglobalize and enter a multipolar world with hemispheres of influence. Like non-sovereign money is what needs to perforate those hemispheres of influence and facilitate global trade between them, not the dollar, because the dollar belongs to one entity in particular that's becoming less the global hegemon and more like a hemispheric influencer. So, if you're a sovereign holding dollar denominated assets and dollars on your balance sheet, you could reasonably be expected right now to be in meetings with the head of your country and other important people saying, oh shit, like maybe we should let some of these US treasuries roll off and invest some of the proceeds in gold and Bitcoin instead.
Yeah, it's a tsunami wave that's taken over the entire monetary world order. Unstoppable.
But a surfable wave, not like
surfable
a
tsunami
kill
wave. Yeah,
everything
exactly.
wave.
One that if you got it, the surfboards like you if you hold the Bitcoin, so
yeah, exactly.
you're safe from it. So obviously now moving on, many in the crypto space would say it's a tale of two cities as it relates to Bitcoin and altcoins. The worst of times, the best of times, and you've obviously coined the famous inverse alt season. So I mean, but you are bullish on some altcoins and you obviously bearish on others. So I guess the question is, what are you actively shorting and what are you very bullish on and holding?
So I believe that only the real businesses will survive in crypto. And as far as what you care about as a retail token trader, even if you're holding the token of a real business, your token is still going to zero unless that token has some legit connection to the underlying business. So let's just take, for example, I don't want to get myself in trouble here, but let's imagine a token that's linked to, let's imagine hypothetically MetaMask has a token, right? MetaMask is a real business that generates a lot of money. And let's say that they mint $Meta and airdrop it to users. If that token is just a governance token, or it's just a token that's named MetaMask but has no other relationship with MetaMask business, that token's going to zero. So I think a token is just a meme unless the underlying project is earning money and using that money, most of it, if not all of it, to buy back the token and burn it, right? That's the only way you can pass back money to token holders in crypto that's legal. Can't dividend, it's not tokenized equity, that's illegal. So basically, A, is it a real business? B, is the token getting bought back and burned but with revenues from the business? If A and B are true, you can feel confident in the token. If either of A or B is false or both, your token's going to zero. It's just a meme coin, and meme season ended last summer. So basically, what I coined on the 1000X podcast was inverse alt season is the new alt season. You can just be short alts and make money 4 out of every 5 days. Like my favorite short is Whiff. What a disgusting dog shit token, right? Like it could bounce.
Literally dog shit, literally.
Yeah, it could bounce if every crypto asset is bouncing. So maybe be short it versus Bitcoin, but be short Whiff somehow. Meanwhile, Hyperliquid, what an amazing business, right? An exchange is the best kind of business in crypto, and Hyperliquid, to the best of my knowledge, takes 97% of their fee profits and just buys back tokens, hype tokens. Like what could be better than that? When the market shits the bed and volatility is off the charts, people trade more fees, more buybacks at lower prices. Like it's kind of got a floor under it. And the same when there's volatility to the upside, and in the middle, it just performs like levered beta to Bitcoin, which I'm already bullish. So I think that what Avi said on our last podcast is that we've passed the .com crash, 2000 .com crash moment for crypto. Before that point, even the pets.coms of crypto would rally, right? Everything would rally. Alt season was just when you would make money being an idiot. Now, and you got one in 2017 and one in 2021. Now, what emerges will be like the Amazons, the Googles, and the Facebooks of the world will perform, and most tokens will just continue trading to zero as founders cash out, give up, sell their tokens, VCs unlock and sell their bags. So, I gave you the 2 metrics to determine whether a token is worth holding or not. Bitcoin is kind of its own separate animal. The L1s are their own separate animals. But for every other altcoin, is it a business? Do they reward the token holders with business income? If yes to both, you can probably feel okay about it for the next big bounce. Otherwise, be short or just don't touch.
Got it. That obviously relates to Hyperliquid. And that you've also guys have talked about TAO, Bittensor quite a few times. Is there a similar thesis behind that in terms of?
TAO is a little different. I think there are businesses inside of TAO is really early stage. It's like an early stage version of Hyperliquid, and I'm still getting my head around it. But ultimately, I think that inside of TAO, trading the tokens of the subnets is a little bit like what DeFi was like in 2021. You can use it to stack more. You can yield farm and stack more ETH that way, and ETH will structurally rally as it becomes the L1 for certain types of computation and decentralized activity. I think that TAO has the potential for that, basically just incentivizing the best models. But I think it's like maybe 5 to 7 years behind ETH in terms of its relevance. It's like cycle of relevance. So I think it's a much earlier stage bet. Hyperliquid's clean, black and white. It's just an exchange. Exchanges work. We all know that. TAO is like a tradable VC bet on what will be relevant, most relevant, and a great business in 1 to 3 years.
Got it. I'm just curious, and also TAO, because in Bittensor, it's like the protocol level, it's pretty similar to Bitcoin in lots of ways, right? In terms of, the amount of coins that are out there and all that, right?
Yeah.
Cool. So finally, just moving on to a bit more of a philosophical one. You've seen markets at their best and their worst, and crypto can be quite brutal. So like 80% drawdowns, exchange blowups in 2022, etc. You name it. Yet you're still here, you're still trading, and indeed tweeting, never give up. So what keeps you in the game?
I love trading. I think markets are so interesting, and I love that they're, crypto in particular unites a lot of different disciplines. There's a macro, geopolitical, geostrategic angle. There's like a market microstructure angle, a policy angle, just good old fashioned commodity style liquid asset, volatile asset trading angle, a psychology angle. But then also you have crypto assets tokenizing things like art, music, culture. You have an online decentralized trading floor where I can learn and both share and ingest financial education every day. To me, it's like I've met a lot of great friends through crypto, a lot of really interesting, fascinating people who do all sorts of different ideas. And I believe that ultimately this is disruptive technology that will displace a lot of traditional finance, unlock a lot of gates for retail users, generate a lot of wealth. And just working on my own projects in crypto as well. I'm a builder as well as a podcaster and a trader. I've noticed that it's much easier to align incentives with a token, with those buyback tokenomics that I mentioned, when you're trying to build a small online business than it is to with a 100-page startup equity safe agreement. So I do think it'll disrupt the LLC and continue to spread its tentacles into society. I mean, ultimately, what keeps me going is a genuine belief that the just like macro at the highest possible level. I think that ever since Nixon took the dollar off of the gold standard in the 70s, the human incentive for abuse of a fiat currency is going to continue to manifest itself and already has. So I do think that Bitcoin will, in the short run, keep central banks honest, and in the long run, very long run, who knows when, it'll eventually displace the dollar as the global reserve currency. So I think that'll keep crypto as a whole relevant. And then inside of that, I don't think there's a better way to move value around than crypto. Like I'd say moving stable, like fiat linked value around, like a US dollar. In the United States, you can use Zelle. I'm sure where you're based, there's probably some relatively decent payment system that's better than a stable coin or as good as. But like, let's say I want to transfer a share of SPY, the S&P 500 ETF, from me to you. Like, that's going to take 6 weeks, 3 to 4 hours of phone calls with JP Morgan explaining why we're doing that, or Bank of America, or whatever bank you use. And like, it's gonna take forever, and it's not gonna happen. Or let's say that I want to give you equity in my project. That equity is obviously not pegged to the dollar. It floats. It goes up if our project does well, or goes down if our software project goes poorly. Like, if I want to transfer that to you, like I said, there's a 100-page document involved. Or I could just send you a token, right? Or I could just send you tokenized SPY, and it happens at the speed of a block. So a couple seconds if it's on Solana, or 15 minutes if it's on ETH, or whatever. Or sorry, you get the drift, right? Forget the block times. It's the best way to move floating value in the world, crypto, by a long shot, and will always be that way. So I think that that's the reason why it has already disrupted global finance and certain other areas, and will continue to do so as the regulators get kind of DDoS attacked by the usefulness of this product.
Yeah, that long-term perspective is key.
Yeah.
Well, thanks a lot, Jonah. This has been I've really enjoyed this conversation, and I learned a lot. So guys, of course, I will link down to the 1000X podcast below, as well as your personal Twitter. Where else can people follow you? Is there anything else, any other places you want people to follow you at?
Nope, that's it. Thank you so much for having me on, Nick. Really appreciate meeting you. Let's
My
stay in
pleasure,
touch,
man.
and yeah, just
Yeah,
let's keep listening to
yeah.
each other's pods. I learn a lot. Thank you.
Will do, man. And good luck with the markets today over on your side. Take it over.
Oh gosh, we're
Yeah,
up so far, so it looks decent. All right.
so far. Yeah, I don't want to. Yeah, I want to wake up with Bitcoin above 95K.
Me too. Me too.
Cool, man. Thanks a lot.
See you
Cheers.
soon. Later.